Joining us now with more on Walmart's numbers, and it's Investor Day today. Brandon Fletcher, Senior Analyst at Bernstein, and Tim Lesko, Partner and Portfolio Manager at Granite Investment Advisors. It's a really solid investment firm, right? I mean, it's a good name, is it not? It's like, what could ever go wrong there, Tim? It's just hard to imagine. I mean, it's very solid.
Well, when we were searching for names to name our firm, Granite seemed like a natural being that we're in New Hampshire.
Awesome, like The Rock. So coronavirus is sort of a something out of the company's control, obviously, or at least we know about it. It's a given. What are you looking for in the numbers, Tim, that are most important? Online sales or some of the continuing efforts of the company to take on Amazon? What's most important?
Well, I think there's two things that are most important to us. One is that Walmart, a couple dozen years ago, moved into grocery, and that move, which was widely panned at the time, has really led foot traffic to stay steady, and you're still seeing same-store sales growth in a retail industry that is really, really under a lot of pressure. So we're pretty happy to see that. Even though same-store sales were a little light compared to street estimates, they were still positive. And second is the online business. They continue to spend a lot of money and have done a really good job of growing that online business, and people fail to recognize that they're the second largest online retailer in the U.S.
You don't think of the you don't think of the grocery business being highly profitable. Margins are so slim, but it keeps the traffic going, in your view. It's worth it.
Right, and that's been the secret, right? Stores that are able to maintain foot traffic, whether they be stores that are people hunting for bargains in the TJ Maxx's of the world, or people that are going for grocery and then buying other goods, really creates a strong backdrop against companies. You saw Pier 1 go bankrupt over the weekend. You're seeing bankruptcies all over the landscape. You have to drive foot traffic.
So Tim, earlier on CNBC, the former, I think, president of Walmart was describing that, yes, commerce sales 35%, that's great. But what that really means is the 1.9% same-store sales number means that the bricks and mortar sales were down. And media and gaming being mentioned, Amazon comes to mind. Amazon has two revenue streams that Walmart doesn't, Amazon Web Services, AWS, and advertising that have huge margins. Aren't they using those, and will they not continue to use those as loss leaders when it comes to Walmart?
Well, I think that's why Amazon is such a difficult competitor. They have businesses outside of their core retail business that really drive the profits, and they're continuing to sell goods at a loss online. But interestingly, you have Amazon that's moving from being a virtual merchant to now a bricks and mortar merchant, getting into grocery, getting into daily distribution of goods to people, where Walmart's been doing that for years and has all of the goods in your geography. So in the future world of same-day delivery, next-day delivery, Walmart's very well positioned to provide that service. So it's almost like they're both heading towards the same way, and Walmart at a much better valuation.
So let me get to Brandon. Brandon, you heard a lot of what Tim's saying. Do you have any contrary views, or he's got it right?
Yeah, I think the subtlety that we'd add there is that there may be actually higher profits in grocery going forward, and that's probably the more controversial view. The reason that might be possible is that in the U.S. we have 20 to 25% of our share in the hands of mom and pop grocers. And so there are ways to do click and collect, especially if you stop actually walking around a physical existing store, but you have a purpose-built store, which customers don't walk in. It's actually just a pick facility. There's one of those they've opened in Chicago last summer. Then you can actually have, we think, lower operating expenses, lower CapEx than what was spent to build an original store, and roughly the same sales as a small grocery store. And that could be a higher IRR than Walmart has had since probably 2002 or 2003 on those vintage stores. So that's where we think there's an incredible opportunity, which is why misses like this don't necessarily kill the potential of Walmart.
Yeah, I would just say that margins are going up at Amazon, so they have more firepower to compete. And as I've seen them, they've been going down at Walmart, maybe stabilizing now, perhaps, as you say, because they are doing a lot in technology. And I think every company is going to have to do a lot more with technology if they're going to survive in this environment.